Rotation masks thin SPY support at 730 to 750 as long yields press toward 5%. Is the U.S. government accepting higher inflation to hold massive debt in check? Is inflation Trump's solution? Markets are choppy and indecisive. Our smart money tracker shows why. Since June we've seen alternating bearish and bullish impulses alongside alternating accumulation and distribution. That rotation produces a sideways, whipsaw market. In physics, systems oscillate more as they near instability. In markets, a stable bull trend often gives way to a highly oscillating top. We don't yet know if this is a top or a consolidation. The tracker shows only thin support and resistance in the 730 to 750 range on SPY. Below that sits a large gap from the April-June rally on very thin volume, just an observation, not a manipulation claim. Solid support sits around 680. Could we see a pullback to 680? Seasonality points lower over the coming days to weeks, and midterm election years tend to have weak Q3 performance. We lack obvious catalysts for such a correction. Our risk analysis doesn't detect material stresses in the system right now. We track volatility, credit, liquidity, funding, and yields. Almost all are in the green or yellow range, not flashing red. This is supportive and helps prevent a broad sell-off. However, untracked risks always exist. 1. The U.S. debt time bomb is building, driven by exuberant spending by the Trump administration and an upcoming debt refinancing wall in U.S. borrowing. 2. Fed policy is becoming less transparent under the new chair. This is happening amid rising geopolitical tensions that could spark an oil crisis, alongside higher inflation and a potential need to raise yields again. Although the latest monthly CPI appears driven by higher energy, transportation, shelter, and other goods and services, we can only speculate whether this is intentional, to inflate away the massive U.S. debt, in an environment where rising interest rates could detonate the debt bomb. Inflation shifts the burden toward the U.S. middle and lower classes. With inflation not really under control, the 30-year remains in a consistent uptrend and might break through the critical 5% level. High yields are never good for stock markets. The only solution here is the Fed, which might start buying treasuries or some form of quantitative easing. Short-term bonds are already being bought by the Fed. Technically, we are in a stealth QE regime right now. This chart shows what the Fed ranks as top risks: geopolitics, oil shocks, AI, and private credit. The private credit shadow market is now believed to be larger than the regulated credit market. Borrowers with weaker credit profiles often turn to private credit and pay higher yields. Since the Great Financial Crisis, the regulated credit market has been heavily constrained, while private credit evolved in parallel and is now a major market. Many data centers are financed in that sector as well. The risk is often distributed to pension funds and other savers, echoing the pattern before 2007. Total debt balance and its composition show growing debt pressure on U.S. households, driven mainly by high mortgage rates, student and auto loans, and credit cards. Given this data, the question arises, where is equity market demand coming from? If the lower and middle class is struggling under debt pressure, who is buying stocks? And why is the debt creation of the U.S. government supporting the economy? In other words, is the liquidity created by the government finding its way into the economy and to middle and lower income households, or is it flowing to hyperscalers and the billionaires who own them? Percent of balance 90+ days delinquent is rising. Parallels with the 2007 Great Financial Crisis are becoming evident. We may be seeing early signs of a data center bubble. Even the semiconductor trade seems to be losing momentum right now. A recent dark pool trade printed lower, indicating it was most likely a sell. Now, what to make of all this? The market prices these risks mainly as medium, to long-term and still seems focused on AI hyperscalers, data centers, and growth, creating a high volatility environment ahead of the Q3 earnings season. At the same time, energy is the strongest sector, typically a late cycle leader, suggesting we are in the last phase of the recent rally. Energy is currently the strongest sector, which can look like the beginning of a bull trend but often marks its end. The best opportunities lie in single stocks, not in broader indices, as rotation creates choppiness. Find them using our markets in Vitro stock screener, which lets you filter by sector, statistically validated patterns, accumulation relative to market outperformance, and insider trades. Use our analysis chart. It shows accumulation around the support level of $33 and a statistically significant bullish pattern yesterday. Track the activities of smart and institutional money visually, spot earnings trades, and find buying opportunities at good support levels easily. For deeper charts and the stock screener, visit markets in Vitro.